of the company, is with us here. Mr. Duggal, good afternoon. The volume growth for you this time around is a little over 4%, but demand continues to be very listless in the sector as a whole, including for companies like yourselves. Should we continue to expect this low single-digit volume growth even in the second half of the year?
I think volume growths will trend up. We do see a little bit of improvement in the market sentiment, but I think more importantly, we will be driving promotions very aggressively to see the volume growths at a much higher levels than what we have seen so far. Now, this could have some negative impact on margins, but I still think that the trade-off is to our favor, to our advantage, and we should invest heavily behind our brands and drive volume growth.
Okay, so when you say volume growth will trend up, what are you looking at? Because, you know, at same time last year, your volume growth was somewhere around 8.5 to 9%. Is that a more reasonable target to assume by the second half of the year?
I think we'll be looking at that kind of number, between 5 and 10, perhaps closer to 10%. And to do that, we'll have to really swim against the tide because, as I said, the market sentiments still are very negative. The demand consumption side is very stressed, including the rural. Now, even if there's a small uptick, it may not be lasting. So we will really have to invest behind our brands to drive that kind of volume growth. But I think we are pretty committed to do that. And we believe that a 5 to 10% range, perhaps towards the upper end of this range, is eminently possible in the second half.
Mr. Duggal, good afternoon. Do you think we are at a stage where maybe companies like yours need to maybe compromise a bit on EBITDA margins to drive the volume and sales growth? Your EBITDA margins have been quite healthy, and in fact, in this quarter, they've actually gone up. Do you think maybe we're going through that phase where you might have to take a bit of a hit?
Yeah, I think we are prepared to do that. Nothing significant, though, but we are prepared to have a small erosion in our EBITDA margins if it means that there is a substantial improvement in our volume delivery. So that's something which we are now in a process of doing. If we are lucky, then the demand side will also improve, and therefore the margins will remain pretty constant. We may not have the same promotional intensity as we are currently planning. But we are prepared for the worst case in terms of some level of erosion of margins.
And what would be that worst case and cost benefit analysis? What kind of margin erosion and, I mean, you know, and what kind of volume growth if that has to be compensated?
Well, let's put it this way. I would be willing to trade off, say, 50 to 100 bips of EBITDA to drive a 10% volume growth. So that's the kind of trade-off we're looking at. I mean, I'm putting it very crudely, but broadly, that's the thinking which we are embarked on at this point in time.
Okay, well, it's not crude because I'm sure that the competition is getting very intense, not just from newer players like Patanjali, but also from, you know, well-entrenched players like Imami, Godrej Consumers, in segments that you get more than 50% of your revenues from. So just tell us how much is the promotional expenditure that you have incurred exactly in this quarter? And as a percentage of overall sales, how much do you think it can go up by in the second half of the year?
Well, if you take consumer promotions, which is really what we are doing very aggressively and not trade promotions, they would trend up from around 3% to more in the region of 4–4.5% of revenues. At the same time, we may take down the level of intensity in terms of above-the-line spends as well as in terms of the trade promotions, what you give to the intermediaries. So the focus would be on consumer promotions, offering better value to the consumer and having better offtake for our brands, and gaining share at our competitors' expenses.
Okay, Mr. Duggal, thanks a lot for joining us. I would have